Okay, welcome to our Finance Friday weekly call. My name is Jerry Fetta. I'm the owner, founder, CEO of a company called DynamX. And every Friday, we come to you with real financial literacy, simple, practical, true finance. And so something that I'm going to cover tonight is one of my favorite topics. Honestly, it's one of the things that I've spent the most time learning about, doing in my own finances. But I want to cover some of the myths, some of the things that aren't true, some of the things that get confused on this topic. So this is called the infinite banking concept, right? And what I'm going to do is I'm going to explain to you what that means. Some of you guys are clients. You already have an infinite banking concept policy. Some of you guys are not yet clients. Maybe you're looking into it. Maybe you're interested in it. We call it the sacred account. And I'm going to share with you why we call it the sacred account, why we call it something different, and what some of the real true differences are. Okay. Now, before I dive into this tonight, a couple of things I love covering, ground rules every week. So number one, I want you to have a purpose for being here tonight. If you're not here with a purpose to learn, to apply the information, it's kind of like, what are you doing on a Friday night on a finance webinar? It almost becomes weird, right? Like is this really your form of entertainment, right? So we want to make sure you've got your purpose lined out. What are you trying to learn? What are you trying to apply? This is, again, talking about the sacred account or the infinite banking concept. And so if you have one, I want you to think about, okay, how can I apply what I'm learning? If you don't, same thing. Okay. Now, second thing is I want you to ask questions. We will go live and answer questions throughout the course. So as you have them, drop them in the chat. If you're on Facebook, we'll answer them and I'll read those in the comments. If you're on Zoom, we'll actually mic up and I'll talk with you and we can answer your questions there as well. So make sure that you have a question, you ask it. If anything doesn't make sense with finance, it comes down to two things. Okay. Two things. It comes down to vocabulary and it comes down to math. I either said words you didn't understand, or I went over a math problem and I did numbers you didn't understand. All of those are simple and they represent concepts, both math, numbers, vocabulary. Those are just symbols. Again, it's not about the symbol. It's what does the symbol represent? So if I can help you understand what does that symbol mean? Okay. What does that represent? What do I need to know? What's the concept? Then it's much easier for you to learn about this stuff. Okay. So that's the next thing. Ask questions. And I want to remove the idea that any of this is unlearnable. Okay. I didn't go to college. I do not have a degree in finance. I was a C average student in high school. My parents were divorced. I didn't grow up with money. Like all of the statistics and all of, my background and socioeconomic status as a kid and a young adult point to the fact that I shouldn't be able to know this stuff. Okay. And I do. And I'm only 29 years old. I've done very well with this stuff. So this is not unknowable. Anyone can know this. Anyone can learn this. And I want to make sure that you have that in your mind as we're talking tonight. And then the other thing is getting rid of the idea that we know it all. Those are the two barriers that are any student, any learner. You are a student right now. If you're watching this, is going to come across either I can't know this, it's too hard, or I know it all already. There's nothing I can learn. Right? If we can get rid of those two things and then combine that with the fact that you've got a purpose and a reason for being here, this is going to be golden. Okay. So that's the thing. And then obviously be positive, be a contributor, no negativity, and just make sure you understand that people are here to learn about finances. If you're here tonight, you're a producer, you're trying to learn, you're trying to grow your finances. I love you for that. I respect you for that. If you're not of that mindset, kindly exit the stream. Okay. Now, without further ado, I want to jump into the actual material of tonight's course, which is the infinite banking concept. Okay. Now, first things first, this is a marketing phrase. That is all this is. So you see the infinite banking concept. I don't want you to think that that's some complex, sophisticated, financial nomenclature or vocabulary or words that are, this special thing. No, this is a marketing phrase. Okay. The infinite banking concept, it literally doesn't mean anything. It's just a marketing phrase that people use. This was developed by a guy named Nelson Nash. Okay. Nelson Nash was a life insurance guy back in the 1970s and 80s. He was also a real estate investor. And so he developed a concept of using whole life insurance. Okay. We'll talk about what this looks like in a little bit. Whole life insurance to be able to borrow against. So we fund it with cash, just like we would with a bank, and then it earns dividends, and then we borrow against it, and we can use this for self-financing our real estate purchases, buying vehicles, buying homes, all sorts of cool things, right? But this is what it is. It's whole life insurance. We're going to fund it. We're going to borrow against it. Now, this is a great concept. It's been around, like I said, like Nelson Nash came up with the concept of infinite banking, the actual marketing term, but this is based on something called BOLI and COLI, bank-owned life insurance and corporate-owned life insurance. Okay. So when I was learning about this, I didn't know about this side of things. All I knew was I kept hearing this thing called infinite banking concept. Now, to give you some context, I was a Dave Ramsey financial advisor for like 5 years. I was endorsed by him as a local provider in like 8 different states. So I ate, slept, breathed, buy term insurance and invest the difference in mutual funds. That was what I thought the way to wealth was. I was licensed to sell investments and mutual funds and retirement planning, and I was very good at that business. And so when someone would talk to me about whole life insurance, if you know anything about Dave Ramsey, you know that that's the devil. You don't buy whole life insurance. So that's what my mindset was. So I want you to realize like the magnitude of like, this is like you like a Christian converting to like being a Muslim or vice versa. Like it's not just somebody that's like flapping out in the wind looking for a product. Like I was firmly against whole life insurance at the time I heard of this. Okay. So I didn't know about the bank-owned life insurance side. So when I thought of whole life insurance, I thought you just buy really expensive life insurance and, you know, you run out of money at some point and it's not a good deal and you make almost nothing on it and there's no reason to buy it. I thought it was just a terrible financial product. Now, there is a way to design it like that. 95% of life insurance policies, whole life insurance policies specifically, are designed that way, where all of the money goes to insurance costs. There's nothing in the cash value. There's not anything that you can borrow against. The agents make giant commissions. The rate of return is measly and terrible. And that's a piece of crap. That's a turd. Like people sell those today. They're not good. Right. So that's a type of life insurance under the basket or the umbrella of whole life insurance. All I knew was that. Okay. And that's all most people know. I didn't know about this bank owned and corporate owned. Okay. So as you know, my story, I was a financial advisor. I was helping clients with all of the Dave Ramsey stuff. You know, like I said, pay off your debt, buy term, invest the difference, buy mutual funds, max out your 401k, you know, put the rest in a Roth IRA, pay off the house, and then live your legacy. I know the baby steps by heart. Okay. And so that's what I was doing. I was like, okay, that's what I'm focused on. Now, I was financially illiterate at that time. I've said this before. As a licensed financial advisor, I was financially illiterate. I had taken the federal exams and the state exams and passed them with flying colors, meaning I wasn't uneducated on what the exam said. I knew what the answers were. I knew how to be a financial advisor, but the material that they taught me on those exams had nothing to do with building wealth. Okay. It had everything to do with the rules and regulations of selling retail financial products. Okay. Retail financial products, they're products, investments that are peddled and marketed to consumers. Put money in the 401k, the 401k and mutual funds. That's a retail financial product. Buy this annuity product. That's a retail financial product. Real investors don't buy those things. Okay. So I started learning about all this and I was like, okay, I had heard about the infinite banking concept. The very first time was from a guy that worked at New York Life Insurance. And I literally made the guy quit his job. Okay. And I was wrong. I didn't know what he was talking about. I thought he was selling, you know, a crappy life insurance product. I didn't know that he was trying to mimic the strategy I'm going to talk about tonight. But I told him, I was like, bro, over the phone, I was like, you're wrong. What you're doing to families is terrible. Shame on you. I can't believe that you can sleep at night. Like I ripped this guy to shreds on the phone. He called me the next day. He's like, I thought about what you said and I'm quitting, you know, quitting New York Life Insurance. So that was the first time I heard about it. Second time I heard about it, same thing, was from a life insurance guy and he was trying to explain it to me and I wasn't hearing it. I was like, dude, you're selling whole life insurance. That's a piece of crap. That like, no matter what you tell me, that's a piece of garbage. I'm not even going to look at what you're saying. Okay. So this is the second time I heard about it a couple years later. The third time I heard about it, I was actually researching. Okay. So this was back in 2015, 2016, when I started realizing as a financial advisor, I was financially illiterate. I didn't know about real wealth and real money. And I was just selling, you know, retail financial products. I was a product mule for Wall Street and chain banks and the IRS. And I realized that, and I was like, okay, well, I need to figure out, what do wealthy people actually do with their money? Okay. How do they earn it? Where do they save it? Where do they invest it? How do they pass down their legacies? How do they build their wealth? And so I was doing this independent. There's no direction, no guidance. This was back in 2015, 2016. There wasn't TikTok. Social media was there, but it wasn't as booming as today. Like people didn't trust Facebook ads. If someone was advertising, it's like, that's a scam, right? So I was trying to figure out on my own, without any guidance, without any courses, without any mentors, where do the wealthy save? Okay. And I kept coming back to whole life insurance. Okay. And there was a part of me that was like, bullshit, like that. I would ignore it. And then I would go look somewhere else because I was like, that can't be the right answer. There's no way that that's the right answer. So I would ignore it and I would go look elsewhere. And then I would come back to whole life insurance. Okay. And it happened enough times that I was finally like, okay, well, I need to see what this is. And so this concept of bank-owned life insurance and corporate-owned life insurance looks like this. If I have $1 that I put into a life insurance policy, okay, $1, for example, when I put $1 in, this dollar is going to grow at a 3 to 5% compounding annual growth rate. The annual compounding interest of this is going to be 3 to 5%. It's tax-free growth. Okay. While this is happening, I can borrow 70 to 90% of the value of this $1. So 70 to 90 cents. If I do this correctly, my cost of interest is only going to be about 1 to 3%. Now, here's the beauty of this. This 3 to 5% is not taxable because I'm borrowing against it. The IRS can't tax loans. Okay. This is something that most people just learned about this year when it became popular with all these 1%ers doing it. We've known this for years. The IRS can't tax loans. So while this dollar is earning 3 to 5%, I can borrow 70 to 90% of the value of it from day one. I'm going to pay 1 to 3% interest, but this entire dollar still earns 3 to 5% while I do that. Okay. Like it's literally like money is now in 2 locations at the same time. I've got $1 growing at 3 to 5%. It's not taxable. By the way, this dollar protected from creditors, protected from lawsuits. Okay. It's protected from taxation. It's guaranteed to pay out. It's guaranteed against loss. There's no volatility. There's no fees, none of that. So I'm getting a clean 3 to 5% no matter what, guaranteed, right? And while that's happening, I can use 70 to 90% of the value of that dollar, still earn the 3 to 5. I'll pay 1 to 3% interest. And then I can do things like pay off debt, right? What's the interest on my debt? 8, 10, 12, 15%. Okay. So if I pay off my debt and I'm now not having to pay 15% interest on a credit card, I'm now earning 15% by not having to pay it. Plus I have 3 to 5% already happening on top of that. So I'm making, what is that? 15 plus the 3 to 5, that's 18 to 20% on my money. Same thing with if I invest, I can invest in real estate. I can do private lending. Okay. I can earn 8 to 12% here on a private lending deal in passive income. And if I take this 8 to 12 and I add in what I'm earning here, 8 to 12, that's again, I'm earning, 15 to 18% on my money in 2 locations at the same time. Okay. This was the concept. So again, I'm a Dave Ramsey guy. I don't know anything about this. And I do my research and I don't know how, but somehow I came across an actual illustration, a life insurance illustration for this exact concept. Okay. And what I saw was exactly that. I saw, they were putting, let's say $10,000 a year in contributions. And this was on the illustration. And then I saw that they had, $8,000 immediately available in their cash value that they can borrow against. And I saw that they had a death benefit, right? And then I also saw the rate of growth. I looked at okay, what's my starting value? What's my ending value? What's the rate of return? And I saw it was within that 3 to 5% range. And I was like, like my mind was blown. I didn't know that this was a real thing. So I finally saw it was a real thing. And now I was aware of it. And that's where a lot of people are today. They're just now becoming aware of the concept. The idea that we can use life insurance and we can do the banking concept and we can put money into it and we can borrow against it and it can be tax-free and we can do this, earning returns on the same dollar in 2 locations at the same time. Okay. That's called arbitrage, earning a rate of return on a single dollar in 2 locations at the same time. Banks do that. It's called arbitrage, right? So we learn all this stuff and we're like, man, that's awesome. Okay. Guys, again, I was a licensed financial advisor. I was a licensed life insurance agent. I was what I thought was financially literate. It took me, I think over the course of a weekend, 36 hours of study consistently all in one weekend. This was over Christmas one year. Over that Christmas weekend, 36 hours of studying this before I was like, okay, I understand what's happening. Like I understand what, not how or why or when. I understand what. like the general concept, the topic. I understand what's going on. Now, here's the problem that I have right now with infinite banking concept. We call this the sacred account. I'm going to show you why tonight, but the infinite banking concept in the last 12 months has become 600% more popular online. We did a Google search survey, and my marketing team found in the last 12 months, the search infinite banking concept has increased by 600%. Okay. Ridiculous number. Like that means 6 times more people are aware of the concept. Okay. Now they're not aware of what I just explained to you. See, what I just explained to you is true. They're aware of something called the infinite banking concept. Now, when they Google the infinite banking concept, whether or not they see true information, okay, whether or not they see true information is like totally different. We don't know if they see true information. We see whatever people say the infinite banking concept is. Okay. Now, here's the thing. Avery asks a good question. He says, why the spike? Okay. I think the spike is more insurance agents and more financial advisors have become aware of it. So you'll see more people marketing it, right? So you're going to see, more people like me. I've been doing this for years and years and years before it was popular, before anyone knew who it was or who I was. But you see more people that are putting hype behind it there, and they'll give you simple little things like, you can put $1 in and you earn a 6 to 8% dividend, and your interest rate to borrow is only 5 to 6%. And that's why the spike is people hear this concept and you're like, okay, I've heard infinite banking, even just the term of it sounds cool. Banking, that's a sexy phrase. Infinite, I like that. But they Google it and they don't see any of what I just showed you. And I'm going to show you what they see. I'm going to show you why it's a myth, and I'm going to tell you what's causing this. Okay. So the first myth on this, and I want to break this down. The first myth on this is the actual purpose of the account. Okay. What is the reason we set it up? What's the actual purpose of it? Not what did some marketer or insurance agent or wealth guru tell you the purpose of it was. Factually speaking, when we buy this thing, what is its purpose? Okay. Make no mistake about it. First and foremost, this is life insurance. You are buying life insurance. When you buy the infinite banking concept, you are buying life insurance. Okay. That's the vehicle. That's the actual financial tool being used. It's dividend paying whole life insurance, specifically high, early, cash value, dividend paying whole life insurance. Okay. I know that's a mouthful, but high early cash value. What does that mean? When we put money into the policy, we want a lot of that money available right away. That's called a high early cash value. Okay. So high early cash value. Then we have dividends, right? Dividend means that I am earning interest and profits from the insurance company. I'm actually an ownership partner, an equity partner in the insurance company. So when they profit, I profit. Okay. So there's dividends, and then it's whole life insurance. That's a type of life insurance. Okay. Now, what is the primary purpose of life insurance? A death benefit. This is where I initially shied away from in my career. A lot of marketers and insurance agents don't talk about it. Okay. The primary reason you own life insurance is a death benefit. Okay. When you sign up for a sacred account or an infinite banking concept whole life insurance policy, the first question the insurance company is going to ask is, do you have insurable interests? Meaning, whose life is the policy covering? Who's the beneficiary that's going to receive the death benefit when the insured dies? And is there a reason that connection needs to be there? Right? So I'm married to Lexi. If I die, Lexi would be financially devastated. That's why there's coverage on me that pays out to her. That's called insurable interest. Okay. That's the main reason we buy life insurance. That's the main reason the insurance company sells life insurance. Let me give you, I'm going to jump ahead a little bit. They don't give a shit about the infinite banking concept. The insurance companies, they're not in on that game. They're selling a product. They're selling a life insurance product with a death benefit. They're going to design it any way the agent tells them to, as long as it's legal and it's compliant and it doesn't break any tax laws. So they have software that the agent can manipulate in order to create a certain type of policy, but the insurance company, they don't care. They're open-minded to whatever, as long as it's a policy with the premium being paid on their books. That's all they care about. Okay. So we're buying a death benefit first and foremost. And we need to understand this, because that is why we would buy a sacred account first, right? So I'm trying to build wealth. I'm trying to be financially independent. You are too. That's a game we're playing. Okay. I grew up in a family that, with games, it was shady. Game night was never fair. So the easiest way to win a game is you rig it. Like, I know that's not, full of valor and the heart of a champion and all that stuff. Easiest way to win the game is cheat. You fix the outcome. Okay. So that's what I grew up like. Okay. When I'm playing Monopoly, like, how do I cheat? How do I fix the outcome? Right. So with this, no different. If I'm trying to guarantee a legacy and financial independence for my family, the easiest way to do that is fix the outcome, to cheat. How do I cheat? I tie a permanent death benefit to my life so that if I die, no matter what, my family, my wife, my spouse, they get paid tax-free money. And they're going to be financially independent even if I don't hit my goals. Even if I don't become financially independent in this lifetime, when I die, for sure, no matter what, they will. So that's the main reason we do this, right? So if I am somebody that doesn't have a reason to own life insurance, this might not be a good concept. If I don't have any beneficiaries, nobody that relies on me, nobody that's related to me, I don't have, parents or siblings or a spouse or a significant other or a business partner, then I should not and probably cannot do this concept. And this gets left out. The marketing videos don't tell you, hey, this is life insurance. And if you don't have insurable interest between the insured and the beneficiary, you're not going to get approved. Okay. So that's myth number one. This is life insurance. Now, the other thing that gets skimmed over and missed is the dividend. Okay. This is where I would say 95% of insurance agents either have no idea what they're talking about, or they don't want to fess up and tell the truth because it sounds less sexy, right? So the insurance companies historically, they've paid out what's called a gross dividend of about 6 to 8%. Okay. Now, what does the word gross mean? Gross means before any deductions, any fees, any expenses are taken out. So like when you get your gross paycheck, that's before taxes come out. What you receive at your W-2 at home after taxes is called your net paycheck, right? So when an insurance company advertises their dividend rate, meaning this is how much profit we're sharing back to our policyholders and our policies, and they say it's 6% or it's 7% or it's 8%, that's a gross number. Okay. Meaning there are still going to be fees that come out of that. There's still going to be expenses and costs that come out of that. And when you design an infinite banking style policy, we said that this dollar goes into it, right? So we put a dollar into the policy. Here's the breakdown on this. Okay. Typically 10 to 20% of this is going to go to what's called a base premium. Base premium means it's actually buying whole life insurance. Okay. Base premium is the only part that earns the dividend. That's literally a unit of ownership in the insurance company. That's why it gets the dividend. You're buying like stock almost in the insurance company. So that 6 to 8% dividend, which is gross, is being calculated from this figure. So if you're putting in a dollar, 10 to 20% of that, or 10 to 20 cents, is dividend producing. Okay. Now the other component we have here is going to be, let's say this was 20%. Okay. So probably about 75% of this is going to go to what's called a paid up addition. Okay. PUA, paid up addition. This is, again, just going straight to cash. It's not buying life insurance in whole life insurance units. It doesn't produce dividends. It goes straight into cash value, meaning I can borrow against the majority, if not all of that, immediately from day one. So this earns dividends. This earns guaranteed interest. Okay. So the dividend here, the gross rate is like 6 to 8%. Guaranteed interest rate here is like 3 to 4%. And then you're going to have like 5% or less that goes to term insurance. Okay. This is literally just cost. There's no benefit there. You're not getting anything. It's literally just cost. Okay. This is how you blend a policy. It's called blending. So we've got our base premium, we've got our paid up additions, and then we've got our term insurance. Base premium produces a dividend. It's an income producing asset. Paid up addition produces a guaranteed interest rate. It's also an income producing asset, but it's not earning dividends. Term insurance, literally just a cost. There's no dividend. There's no nothing. So if I put in a full dollar, only 10 to 20 cents of that is actually earning that gross dividend. Okay. 75 cents, maybe 80 cents of that is earning 3 to 4%. And then we've got 5% or less that's earning us nothing. If we take all of that and we blend it together and we take the rated return or the weighted dividend rate, it is not 6 to 8%. Even if it was, that's a gross rate, meaning when you're net, you're going to subtract typically 1 to 1.5% in fees and costs, insurance fees and insurance costs from that number. That's your net dividend. Okay. So here's the problem with this. You're like, that was a lot of math. That's confusing. Doesn't make sense. Okay. Well, have you heard this pitch? You're going to earn 6 to 8% dividends. You're going to borrow at a 5 to 6% interest rate. And so that's your cost, or that's your return. That's your cost. And if you take a loan, you're automatically making profit because you're earning dividends. Okay. This all of a sudden doesn't become true when that 6 to 8% dividend is actually 3 to 5% annual rate of growth. Okay, if I'm only earning 3 to 5% and I'm taking a loan out, I'm not automatically making profit. I'm actually like paying interest. My interest rate exceeds my dividend rate and my interest rate that I'm earning, right? So this is where most people are going wrong. See, if I was pitching that and I was like, it's going to be 3 to 5% growth rate, and then when you borrow, it costs you 5 to 6%. Everyone here is going to be like, yeah, that it costs more than it pays. Why would I do that? That makes no sense. Okay. Well, here's the thing is most insurance agents don't know this. Okay. Like I said, this became 600% more popular in the last 12 months. To answer Avery's question, like insurance producers and agents are starting to learn about this. And they're like, oh, this is a really sexy marketing idea. I can talk about this on TikTok and Instagram and generate leads in business selling this concept. And then all I've got to do is I've got to find someone to design the policy and do the back end for me. And all I've got to do is I've just got to keep talking about the concept. Well, they're talking about 6 to 8% dividend, borrow at 5 to 6%, make immediate profit on your dollar, which doesn't exist. That's not how it works. It never has been. It never will be. What happens when I buy that as a consumer? And I'm thinking about, okay, well, next year I'm going to make a 6 to 8% dividend and I'm going to immediately take a loan and it's only going to be 5%. I'll still earn 6 to 8. I'm going to make immediate profit before anything. And I realize that that's not true. I'm going to have buyer's remorse. I'm going to return the policy. I'm going to cancel it. Right. And so I actually think that the infinite banking concept is in a bubble, no different than the stock market. The difference being it can't crash. Like if people cancel and they're like, hey, this isn't what I thought it was, it doesn't affect my policy. It doesn't affect yours. The insurance company collected the premium already. They're going to give them their cash value and that's done. They'll wash their hands and be done with it. But it's still a bubble. It's getting hype and euphoria and all of the same characteristics of a bubble. And then at the very top, the pin, unfortunately, is going to be misinformation and miseducation on the policy. Okay. Now, here's the issue. If it's become 600% more popular in the last 12 months, that's because, like rough math, insurance agents have been talking about it 600% more in the last 12 months. Okay. Which means most of the insurance agents just bought a policy last year or they don't own one. Okay. It's really easy to talk concepts until it's like, okay, now we actually have to perform the work. With this, if I've never done it before and I sell the concept to you and I sound all slick and awesome and you're like, yeah, I have infinite banking concept. And then you're like, hey, how do I take a loan? And I, the agent, have never done that before. I can't help you. I sold you a life insurance policy. I have no idea how to use it because I literally don't own one myself, or I just signed up for one and I haven't owned it long enough to know how it works. You see so it's like the problem here is people don't know that. They're hearing the concept, they're excited, they sign up, and then what? Right? Like most policies aren't being borrowed against. If they are, I guarantee you that the interest cost is more than what they're earning because people don't know how to set this up correctly. Right? So I want to show you where we do it different. Okay. So I already talked about the dividend. We already broke this down. We tell people that from the get-go. We say, if you put $1 in, you're going to earn 3 to 5% on average. Okay. That's called your compounding annual growth rate, CAGR. It's your annual compounding interest. Okay. This will be, again, tax-free. Okay. So it's protected from taxation. It's protected from creditors. It's protected from lawsuits. It's protected from market volatility. It's protected from loss. protected from Wall Street fees. There's no investment fees for this, right? So this is protected from a lot of things, right? This is also a unilateral contract, which means that only one party can change the contract. That is me. Even the insurance company cannot change this contract once we've signed on the dotted line. It's just me. It's one way, right? So the primary purpose of this was a death benefit. The secondary purpose of this is to store value. Okay, this is a reserve account. This is where I put the money, the cash that I never want to lose. Like no matter what, it's going to be there. Okay. If I get hit with a tax burden, it's going to be there. If I file bankruptcy, it's going to be there. If I get sued, it's going to be there. If the market crashes, it's going to be there. If everyone loses all their retirement, this is going to be there, right? With fees, they don't exist. They can't eat away and erode at my purchasing power. The insurance company can't change their mind. Nobody can interfere with my policy. So when I put $1 in there, that's the dollar that I never want to lose. Okay. The other thing that this protects us against is called opportunity cost. Okay. Opportunity cost means that when I spend $1, I'll never see that dollar again. Okay. When I pay off debt with $1, I will never see that dollar again. When I save $1, it costs me the fact that I could be investing that dollar. When I invest $1, it costs me the fact that that dollar could be in reserves, giving me protection and cushion, right? So by being able to borrow against the dollar, have it grow at 3 to 5%, and also still use it for other things, I no longer have opportunity cost. I can save the dollar and pay off my debt. I can save the dollar and invest. I can save the dollar and spend it. And I'm still getting the growth no matter what it is that I choose to do, right? So I'm getting rid of opportunity cost. But this again is protecting my money. So this is again a store of value. It's a reserve account. So we'll go back to the bank-owned life insurance thing. The number one owner, the number one purchaser of whole life insurance in the United States of America, chain banks. Okay, what is a chain bank? A chain bank is your Wells Fargo, your JP Morgan, your Bank of America, the ones you see on every street corner in every town. Those are called chain banks. Chain banks, they store about 20% of their tier 1 reserves in whole life insurance. Okay. Number one buyers, number one owners of life insurance in the country is banks. Okay. To the tune of about $200 billion. See, now what are banks using it for? They're using it primarily for a death benefit. They're insuring their employees, guys. They're insuring their executive, and they're saying, hey, we paid that guy $3 million when he worked here over the course of, 15, 20 years. And so we're going to insure him for $5 million. When he dies, we're going to get reimbursed everything we paid him. It doesn't sound sexy, but it works, right? That's what they're doing. And so it's like a boomerang. They're going to hire that guy. They're going to pay him, and then they're going to get refunded when he dies. Boom. And it just keeps coming back to the bank. That's the primary thing they do with these policies. They also use them for executive compensation. And they say, hey, sure, we're insuring you. We'll give a cut of that to your family, and we'll give you some of the cash value while you're alive. Okay. Or we'll take the dividend and use that to pay for benefits for you. So they're using it, number one, as a death benefit. Number two, as an actual like insurance compensation tool, like they're giving compensation to whoever it is that they're insuring in some cases. And then also as reserves. That goes on their balance sheet as a cash equivalent, as a reserve. Okay. So they're not like the primary tool of this. They're not out there like self-financing a car and going on vacation with it and all this stuff. You can do that. We'll talk about how to in a second, but I want you to realize that's not the primary things banks use it for. So when you hear somebody saying, banks do this banking concept, no, they do that with your money. When you deposit money in your checking and savings account, they borrow your money. They do things like buy life insurance and real estate and trading and all this other stuff. But that is the banking concept they do. That's why this is called the infinite banking concept. We're mimicking what they do. It's called fractional reserve banking. We're mimicking what they do by using a life insurance policy. They own them. They will use your money to go buy them. But the banking happens with just the fractional reserve lending and banking system, not with the life insurance specifically for them. We're just mimicking it. Okay. So that's the thing I want to cover here. Now, after that, we look at, okay, well, what is the other myth? The other myth on this is that we're not giving an exact duplication, right? Duplication means that we're doing the exact same thing the bank is doing. Okay, we're not a bank. We're not a bank, and so we're not getting exact duplication. We're getting similarity. We're getting an attempt at duplication, right? But we're not getting the exact duplication. I think my audio might be off a little bit. How's my sound, guys? Sound okay? We're not getting exact duplication. We're getting most of the way. So there's certain elements of this that we're not going to be able to duplicate simply because we're not a bank, right? We're not able to do all the same things banks do. And so because of that, we're going to have to work within our own limitations. So when we call it the infinite banking concept, it sure makes it sound a lot like we're a bank. Okay. Avery says sound is good. Thanks, Avery. It sure makes it sound a lot like we're a bank. Well, we're mimicking banking, but we're not actually a bank. So we have to realize there will be some differences. And so we also have to realize when someone says, become your own bank, they're figuratively speaking. It's not literal. You're not literally going to become a bank. You're going to mimic what banks do. Okay. So we're going to get like maybe 90% similarity, which means there might be 10% of a difference between what we're doing and what banks literally actually do. And so it's really important to understand that so that you have your expectations set up the right way. And you're not like, yeah, I'm a bank. I can do everything a bank can do. I literally have had people that I show them this and their understanding was that they're going to borrow their entire death benefit. No. You're not going to put 10 grand into a policy and buy $1 million in death benefit and then all of a sudden be able to borrow $1 million. It doesn't work like that. You're not like, you're going to be able to borrow a portion of your $10,000. You're not going to get $1 million. Like, I wish it was that way. That would be freaking cool if it was that way, but that's what people have heard. Okay. So Mark brings up a good point. So this entire thing, right? Like these are all myths. Mark said another myth, and I want to bring this up too. This is a technical point, but it's true. Is that it's a good investment. Infinite banking is a good investment. Okay. It's not an investment. Legally and by definition, it is an insurance product. So it's not an investment. We're not investing. It's not a security. It's not a stock. It's not a bond. It's an insurance product. So that's a good point, Mark. And a lot of people might use this vocabulary of like, investing in life insurance. It's actually illegal for them to say that. So if you're talking to an agent that whether they're selling you whole life or indexed universal life and they're using the word invest, probably don't do business with that person. Okay. They're literally breaking a federal law at that point. So that's not good. But it is an insurance product, not an investment, right? So again, we're not getting exact duplication. The other thing that we've got to look at is implementation on the back end. Okay, implementation on the back end. When we buy a policy like this, and I'm going to go back to something I said at the very beginning, the insurance company is not in on it. Okay, like they're not like catering to your infinite banking needs. They're not catering to your sacred account. They're literally going to set up whatever the agent tells them. And then it's your responsibility from there to use it for the strategy you're going to use it for. What does that mean? It means when I set one up, they don't know what I'm talking about. We've had people, we work a lot with a company called Guardian. We work with Mass Mutual. We've had tons of carriers. We have people call up the carrier and instead of talking to us, they call the carrier because it's the 1-800 number on the website. And they're like, hey, what's my dividend and how do I borrow? And the person has no idea what they're talking about. Okay. Now, why does that matter? That matters because your agent is the middleman. Like this is one of the only times where you actually do need a middleman. You need someone to actually translate the concept that you're trying to accomplish with the insurance company and make sure that any interference, misunderstanding, non-duplication, all that stuff gets handled so that you can implement it and not have to deal with this giant corporation that has no idea what you're talking about. And if you start saying things like banking and sacred accounts, they're going to be like, what the hell is that? Like we sell life insurance. What are you talking about? Okay. So implementation on the back end, what does this look like? This looks like number one, like again, beyond marketing, beyond, I heard the concept, it sounds cool. Number one is I have to be able to design as an agent, an illustration that's actually real. Like it's actually going to get approved. Meaning it like not just it looks great on paper, like it's actually going to get approved by underwriting. They're going to say, yeah, we'll actually approve that. And then once it's approved, it's actually going to perform similarly to what it illustrated as. Okay. In the insurance world, the initial illustration, when you get the first illustration, literally means nothing. Okay. Even on whole life, it's basing it on the current year dividend. Well, guess what? Next year, the dividend is going to change. So the illustration you got on your first year literally is invalid because now it's got a new dividend. So we don't care about the initial illustration other than just showing it to underwriting and them saying, hey, yeah, we'll approve that. And, within some semblance of similarity, this is kind of sort of what it'll look like in the future. Yeah, we agree to this because they're agreeing to a contract, and we can show you and say, here's what it's projected to do. This is not guaranteed. There is a guaranteed column. Here's the non-guaranteed column. And we can expect something somewhere in the middle, right? And that's why each year we say do an in-force illustration. So the agent has to be able to build an illustration. Having an insurance license is totally different than understanding illustration software. Guys, insurance illustration software is literally a glorified Excel spreadsheet. And the agent or the design team has to be able to go in there, and they have to know which numbers to plug in, which functions to select, what the interplays and interchanges are, what happens if you put this, what happens if you put that. And it has nothing to do with life insurance at that point. It has everything to do with the technical manipulation of a software app. Like within the confines of that software, you design the best policy based on what's real, what the software will allow, and what underwriting will likely approve. Okay. So just because I can make a great marketing video about this doesn't mean I can build illustrations. Most agents can't. Okay. Our team can. We understand it. It's something we've learned. It's something we've practiced, right? So whether you worked with somebody that does or doesn't, at the end of the day, that illustration is what you're going to show to underwriting. You can build a great one and you can say, hey, I'm going to have really high liquidity and a great dividend rate. I'm going to be able to borrow all this money. But if you send it to underwriting, guess what? They're looking for reasons not to approve it. So that's the next point, underwriting. Just because I can design a good illustration doesn't mean I can get it approved. Okay. What is underwriting? Underwriting is the methodical, systematic investigation of, in this case, an individual to find risks. Okay. The insurance company, they're covering the risk of you dying. So they're going to find all of the reasons why they shouldn't cover you. Okay. Some of you guys that have been through underwriting, you get at the end of it, you get the feeling like, man, it almost feels like they don't want me to have a sacred account. It's true. They don't. They're trying to find reasons not to cover you. They're trying to find out whether you're sick, whether you're overweight, whether you smoke, whether you have family history of health issues, so that they can say, we don't want to cover that person because there's a high chance that they're going to die soon. Okay. So I can design it. Can I get it approved? Because underwriting is not black and white. There's a lot of gray areas. There's a lot of data they look at, but at the end of the day, if I can communicate with the underwriting team and I've got a good relationship with them and a good track record, and they look at my book of clients and say, Jerry's people pay, they don't cancel, they don't complain, they don't abuse and harass our employees, like they're great to work with, we're willing to lean over a little bit on this one because we like working with Jerry. We like working with Wealth Dynamics. If I'm brand new and I just started talking about this on TikTok in the last 12 months, I don't have that track record. Okay. I don't have the relationship and the rapport or even the communication. Underwriting is its own language, guys. Like literally they'll send Lexi emails and our illustration and design team emails, and it's literally just numbers and letters. They're like, case NG612TTO. And you have to look at that and figure out, okay, well, in the index of terms, what does that mean? And what are they telling me? And then what do I do to respond back to that? Most agents don't know that. Right? So a policy can take a long time to get through underwriting or flop completely or just get approved totally other than applied because the agent doesn't know how to get through underwriting. Okay. So let's say that we can do the illustration. Let's say that we can do the underwriting. What's next? Next is the actual implementation. What do I mean by that? Actually funding the policy and then borrowing against it. Okay. So we have funding. We have loans. We're going to borrow against it. We have in-force illustrations. We have loan repayments. We have unscheduled contributions, like putting extra money in. These are all things that happen on the back end. And guess what? Every single one of these has a term. Every single one of these has a special form. Every single one of these has, some special way you've got to do it depending on the company. So again, let's say I do know how to do an illustration. Let's say I do know how to get you through underwriting. If I can't figure out all of this stuff on the back end, and not only figure it out, but be available to help you with it, to educate you on it, right? Then you're not actually going to use a banking policy. You're just going to buy a high early cash value life insurance policy that you never borrow against. You never use it for the right strategy. When you do borrow, your interest cost is more than the dividends and interest earned, and it's not going to work. It's not going to work for the thing you purchased it for. Okay. So here's the first thing. Number one, again, I'm going to go back to, if I'm a brand new agent, I've never actually done any of this in real life. It's all theory. I have no practical experience in real life of taking a loan against my policy and getting a positive arbitrage spread where I'm earning really is greater than what I'm paying the loan back, putting in extra money, pulling in forced illustrations to see what my year-to-year rate of returns look like. I don't have experience with any of that. All I can do is tell you the theory of it. Okay. So you've got to look at, okay, does the team I'm working with actually use this in real life? Do they actually take loans? Do they actually, not only do they actually take loans, what do they do with the loans? Okay. Taking a loan and going on a vacation is a lot different than taking a loan and doing a private lending deal, or taking a loan and setting up a vehicle purchase where I'm setting up an amortization schedule on an actual ledger and paying myself back over 5 or 6 years. Very different things. So then it comes back to, how financially literate is my agent? How financially literate is the guy in the TikTok video or the Instagram reel talking about this? You're seeing him for 15 seconds. Okay. When you sign up, what does it actually look like? What is he actually doing with it? Does he even own one? I know people that sell this concept don't even own one, right? Like, don't be surprised. It happens all the time. So on the back end with the implementation, I've got to look at my funding. Okay. So I have to be able to fund it correctly. When I take my loans, let me address this really quick. So remember, we said people are pitching a 6 to 8% dividend and a 5 to 6% interest rate. And I told you that that's not true. You're not literally earning 6 to 8%. You're earning 3 to 5. And so if you don't do it correctly, you're going to pay 6% interest to borrow, and you're only going to earn 3 to 5. And it's going to be a loss. It's going to be a negative spread. Remember when I said that? Here's how you correct this. When I take a loan, I'm borrowing from my own bank, right? I've set up my own banking system, my own banking strategy. When a borrower takes money from a lender, they always pay the lender back, right? So this idea that I'm going to take a loan and automatically earn profit and never have to pay it back, not only is it untrue, it's irresponsible. And if I'm a life insurance agency pitching that, I'm enabling people to make bad financial decisions. You would never go to your bank and borrow money for a car and then not pay them back. You would never go to your credit card company and max out your credit cards and not pay them back. You would never take out a mortgage on a home and then not pay the mortgage. Why the hell would you do that with your own bank? Like, just because it's my own bank doesn't mean all of a sudden I don't pay myself back. It's no different than saying I own a grocery store, so I steal free meat. It's not free meat. Maya's watching. She's a bookkeeper. That's a loss on your accounting form. That is a cost of goods. There's no income to cover it. That's a loss. You stole from yourself. You made your business unprofitable. So if I'm taking loans and I'm never paying myself back, I'm stealing from my own bank. Not only that, I'm in default. I'm a non-performing borrower to my own bank. Guys, this is why we're paycheck to paycheck. We're financial liabilities to ourselves. Like, don't even worry about the other financial liabilities. When we first start, this is the financial liability. Lack of knowledge, lack of responsibility, bad decisions, blaming other people, looking for shortcuts. Those are all liabilities. So why would I give someone who's currently a financial liability to themselves the ability to borrow from their own bank when we already know they're not going to repay it? Okay. So how do you make this work? I'm earning 3 to 5. I said you can earn 3 to 5 and only pay 1 to 3. How do we go about doing that? Okay. The guy in the TikTok video doesn't know. I can tell you that much. The brand new life insurance guy doesn't know. The person that's all hyped up with their their agency team and they're all rah trying to recruit you, they don't know. Okay. The way that you do this is you pay your loan back. This is a line of credit. Just like the dividend is a gross rate, this 5 to 6% interest is also a gross rate. When I pay down a line of credit, I'm reducing the principal balance of that loan every month, meaning every month the interest is now calculated off a smaller number, meaning I pay less dollars. 6% of 5,000 is less dollars than 6% of 10,000. So logic stands to reason. If I have a $10,000 loan and I pay it down to 5,000, I'm not paying 6% on 10,000. Okay. I'm paying 6% on 5,000, which if I take that number and I divide it by the original loan amount, that's going to be about 3%. Okay. So I am earning 3 to 5% on the entire 10,000. And now if I pay my loan down and off over time, I'm reducing my principal balance and my interest is being pulled off of a smaller and smaller number. And because of that, my net interest cost and my net rate of return. Again, we can't compare a gross number with a net number. It's gross to gross, net to net. The gross dividend is 6 to 8%. We already know we're not going to get that. The gross interest rate is 5 to 6%. If I don't repay my loan, yes, I will pay that. So if I repay my loan over time, then I'm comparing net numbers to net numbers. So now I can look at, okay, it's 3 to 5% net, 1 to 3% interest cost net. Okay. Now, I just said if it's, you know, if I pay it from 10 to 5, it's like 3%. So how do I get this even lower? How do I get it to the 1 to 3 range? There's something called a cash value line of credit. I can actually go to a certain lending institutions and I can get a line of credit against my life insurance. And they're typically going to charge a 3 to 4% gross interest rate. 3 to 4% gross, meaning if I pay myself back, guess what? This is more like 1 to 2 net. Okay, not only that, if I use this for a business expense or an investment, this number can be deducted on my taxes. So now I'm having the government subsidize that. If I'm in a 30% effective tax bracket, I'm paying only 70% of that number because Uncle Sam is covering the difference. See, so there's a lot on the back end of this. It's not just watch the TikTok or the Instagram or the YouTube video, hear all the hype about tax-free dividends and borrow your money and get arbitrage immediately, and then stick money in there and take loans and the money machine just pours out. No. This is a process. This is a system. Okay. So the infinite banking concept is what's being touted. Everything I just mentioned, get your 6 to 8% dividend and your 5% interest rate and borrow and make positive arbitrage. And I'm telling you that that's not real. And unfortunately, that's what the infinite banking concept has become. When you Google it, when you research it, that's what people are saying. That's why we don't call it that. We call it the sacred account. Okay, the sacred account. Why do we call it the sacred account? Because it is a sacred account. You're only going to use this for death benefit, reserves, investing and self-financing, paying off debt. Those are the only things we do with it. Those 5 things. Okay, so I'm buying it primarily because it does have a death benefit. Again, I'm going to build up my reserves. We should have 6 months of expenses in my cash value. In addition to that, we're going to pay off my debt with it, right? My consumer debt. We're going to self-finance our vehicles, our down payments, all of those things. And then we're also going to invest with it. And those are the only things I use this account for. I'm not going on a vacation with that. I read a book that said, you know, this family used their life insurance policy to go to Disney World. Okay, well, guess what? They just took this money, which, you know, sure, it earns a rate of return, but it also has an interest cost, and they spent it on a liability. And they've got to pay that back. Otherwise, they will owe more than they earn. So their Disney World trip wasn't free. It increased their cost because they're going to pay their loan back now. So why do we say only do, you know, paying off debt, self-financing, and investing? Because when I pay off debt, I'm freeing up a payment. The money that I spent on that payment can now cover repaying back my policy. Okay. When I invest, I'm getting passive income. That's why we say only invest for passive income, because that passive income will repay my loan. And I don't have to worry about having this extra thing to pay for every month. Okay. Same thing with self-financing. If I self-finance my car or my furniture, I literally, the couch I'm looking at, I self-finance $5,000 on a furniture set. I did it with my life insurance. So because I don't have a couch payment, I don't have a credit card or a personal loan, I've now got that freed up cash flow that I would have spent anyways. And I'm going to pay myself back instead. Okay. So that only works when I have freed up passive income, cash flow, you know, debt payments, whatever it might be, that service and repay my loan over time. Okay. This is not get rich quick. This is not an instant strategy. And so when somebody hears this version of it, this attracts the financially responsible. This attracts someone that says, okay, you're telling me if I put dollars in this, nothing can happen to them. Nothing bad can happen. They can't get lost. I can't get sued, nothing. And they're guaranteed to grow. And they have for hundreds of years. Yes. 3 to 5% tax-free. And if you do this right, 1 to 3% interest cost. And someone that's financially responsible, that's looking for a long-term plan, is going to say, okay, I want that. It doesn't sound sexy. It doesn't sound like it's this wild, crazy banking strategy. It sounds just like a good idea. Most good ideas don't sound crazy. It's like, you know, I'm going to have steak for dinner. Good idea. I've had steak before. I know what it's like. It's not new. It's not crazy. It's not out of this world. It's just a good idea. I'm going to go to the gym. It's just a good idea. Right? So this is the basis of it. I want to open this up for a couple of questions, but guys, again, these are all of the myths, right? The other thing that I do want to cover, and this goes back to Avery asked, can I re-explain the cash value line of credit? So again, I can go to certain banks and they'll give me a line of credit against my life insurance. So I'm going to do what's called a collateral assignment form. And I'm going to tell the insurance company, hey, that bank loaned me, 90% of my cash value. And so if I die, you guys have to pay that much death benefit to them. And the insurance company says, okay, great, we'll do that. Now, here's the deal again. The insurance companies themselves, they'll issue you loans, but guys, some of them don't like that. There are insurance companies that you can technically set this up with them and you can get the illustration and you can get it approved. And when it comes time to take a loan, they have the right to wait 6 months before they'll give you the money. And they don't like people taking loans right away. So they'll discourage it and they'll tell their agents, hey, we don't want your clients borrowing their money from their policy right away. So they're going to restrict you, right? So it goes back again to like, what company are you working with? Who's the agent? Who's the design, right? And do they know about these other strategies? If I'm with a company that won't give me a loan or they're going to wait 6 months and drag their feet because they don't want to lose the opportunity cost. Like guys, like Mass Mutual, they did a private equity funding round on Walmart before Walmart went public. That's what they could be using the money on. So when they give you a loan at 5%, they're losing. They could be making money like Walmart money. And instead they're making 5 or 6% interest only on you. So not all of them like that. Some of them are strictly in the business of profit. They're not looking at how you use the policy. They just want to make hand over fist. You just cash, cash, cash. So they're going to say, hey, we're going to disallow the loan, or we're going to drag our feet, or we're going to, Q&A and back talk when you try and take the loan because we don't want you to, because we'd rather be doing the Walmart deals, not paying, earning 5 or 6% interest on your policy. Some of them will penalize you when you borrow. If you take a loan out, they're going to stop crediting the dividends to your account because they're like, well, you're borrowing. Why would we pay you a dividend? So you've got to know all these things. Your agent has to know all these things, right? So where do we start on something like this? Number one is we have to realize we're not doing the infinite banking concept. We're doing the sacred account. The sacred account happens in 3 tiers. Tier 1 uses life insurance, and it's simply the concept of collateralizing, meaning I'm borrowing against an asset. Okay, I'm going to collateralize an asset, right? I'm looking for initially life insurance. Why? Because it's the safest asset out there. It can't lose, nothing can go wrong. So I'm going to borrow against that asset. That's all the concept of the sacred account is. I'm going to pay myself back over time. Okay. And I can do this with life insurance. This is called tier 1. I can do this with gold. This is called tier 2. And I can do this with real estate. This is called tier 3. Okay. The concept of borrowing against an asset is not unique to life insurance. Lines of credit are not unique to life insurance. You could take a line of credit out on your car if it's paid off. Like anything that has a equity value that you can pledge as collateral with a bank, you can pretty much get a line of credit for, right? So the sacred account concept is we're going to collateralize long-term stores of value, things that have been around for hundreds of years. We're going to have them appreciating over time, earning dividends, growing, whatever it might be. We're going to take the cash we've borrowed and we're going to do things like pay off debt. We're going to do things like self-finance our purchases. We're going to do things like invest. And the reason why is number 1, we build reserves. Number 2, we build assets. Number 3, we increase our savings rate. Paying back a loan, paying back a line of credit, because it's a two-way loan. A line of credit, I can put money in, I can pull money out. A loan, like a traditional loan, I can only put money in. Like when I make a car payment, I can't pull money back out of the car payment. It's a one-way flow. So a line of credit is a two-way flow. Because it's a two-way flow, it's the same function as saving, right? So by using the sacred account concept, I'm increasing my savings rate. Why? Because I want to be able to save 40% of my gross income. How do I do that? I do that by using the sacred account. When I put money into it as a contribution, that's a savings rate that goes into my savings. When I borrow against it, right, and I pay myself back, that payment back to myself increases my savings rate. It's all pushing me to get into that 40% club, right? So guys, I could go all night on this, but the point that I wanted to drive home is this sacred account, the IBC infinite banking concept, there are a ton of myths. I know like maybe 4 people in the entire industry that are actually doing this correctly. Doesn't mean there aren't more, but I know a hell of a lot of people in the industry, and I can count on one hand the ones that I know are actually doing a good job and teaching people this the right way. Okay. There are people that are just, selling this and they're brand new. They don't own one. They're just trying to earn a commission. And so it's your responsibility as the consumer. I'm going to put this back on you. It's your responsibility as the consumer to educate yourself, to not get involved in things you don't understand, to not look for shortcuts. When you look for shortcuts, that's the number one way to get yourself scammed. The number one thing that makes you liable to being taken advantage of is looking for shortcuts and easy solutions to problems where they don't exist. Okay. There's long range good solutions, and then there's shortcuts. Okay. The snake oil salesman, the guy that peddles all these, weird stuff, that's the guy that's going to sell you a shortcut. This isn't a shortcut. Okay. This is a long-term financial strategy. Okay. So you've got to take responsibility. Okay. And I love that phrase. You don't, when you hear people talk about responsibility, they don't say have responsibility or, it's the word take. It's an active verb. Those that are responsible seize the responsibility, meaning there's the opportunity not to. It's not naturally there. We have to take it. We have to seize the responsibility and say, I'm going to take responsibility, just like I'm taking this hat to be cause over my finances. And there are probably other people that are going to try and take it away from me. And there are probably people that don't want me to have it. And there's people that are going to try and sell me shortcuts. I have to be responsible enough to say, no, I don't want the shortcut. I want the real solution. I want to put in the work. I want to understand it. I want to gain the knowledge. I want everything to be in my control and in my power so that when I get involved in a sacred account or real estate or whatever it will be, whatever it's going to be, I'm in the driver's seat. Okay. So guys, that's all I've got. I want to open this up for questions. I know we've got some in the comments. If you're on Facebook, go ahead and drop your questions here. And I'll go ahead and read them off. If you're on Zoom, drop your questions as well, and I'll answer those live. Good to see everyone, by the way. If you could share this, get this out there. So if you're watching this, if this helped you, if you learned something, if you have a sacred account and you're like, man, I want my friends, family, whoever to know about this, share the stream and make sure others can see this as well. Andrew, good to see you. Brian, good to see you. Brian actually signed up for his first sacred account tonight. Good job, Brian. Okay, question from Maya. Maya says, I just started the sacred account class. I'm sure this is in there at some point, but what is the life insurance company investing in that they can pay us interest? So the life insurance company, they invest in a lot of things. If you look at Mass Mutual and New York Life and a lot of these guys, their assets are like in the hundreds of billions of dollars. So they're bigger than some countries. They're investing in private equity. They're investing in bonds. They're investing in like controlling interest in stocks. They're investing in other businesses. They're investing in commercial real estate. Those of you that are familiar with Grant Cardone, that's who he gets most of his real estate mortgages from. He gets them from the government and from insurance companies. So they're investing in they're the mortgage on some of Grant's properties. That's where they're getting the revenue from. So they get their premiums and all this stuff comes in, but what they do is they take their profits and they do the exact thing that we teach is invest your profits, get passive income. And that way, as an owner, as a policyholder, when I earn interest and dividends, I'm earning a piece of their profitability. And that's where that comes from. Justin asks, is a sacred account a good idea for my minor children? Why or why not? Justin, this is a good starter for them. So it's a good way to set up a payment plan for them. Or if I know you're doing the family management company, the question comes up, okay, well, where do I put that money? You could put some of that into a sacred account for your kids. They do get a death benefit. So that's a benefit for them is they're going to own that policy for the rest of their lives because it's permanent. So they're going to have a death benefit. They're going to be insured. If they start when they're 12 years old and then when they're 19, they get diagnosed with diabetes or they're a smoker or whatever, that can't impact their death benefit. They're already locked in. They already have that. The other benefit too is if you're paying for college, weddings, helping them fund a business, whatever it might be, that's something that they have in their possession. So they can start doing the sacred account concept. It's a great personal finance tool for kids. It can get a little bit tedious, especially for Justin, he has a lot of kids. So that's a lot of accounts to pay attention to. So just make sure if you do something like that, you've got a spreadsheet, you're tracking things, your account numbers, your logins, all of that kind of stuff. But it's very good for kids. You won't get a giant policy. I do want to say that you're insuring the financial burden of losing the child. So you're not going to be able to open up a $3 million policy on a 2-year-old and put in hundreds of thousands of dollars. You're going to get maybe 100 grand, maybe 50 grand in death benefit, and you'll be able to put in maybe a couple $1,000s a year, and you might be able to increase that as they get older. Gene asks, at what point does your death benefit increase? Previously, it's been said that maxing out the PUL will increase the death benefit. Where in the policy life cycle would that happen? Gene, that's a great question. So whole life insurance, naturally, the death benefit increases because the whole life insurance purchases more of itself. So that will increase from that. Also, Gene is right. When you put money into your cash value on an unscheduled basis, that's called an unscheduled paid up addition. Part of that PUA, that paid up addition, does buy a fractional share of death benefit. So you will see as you put more in, your death benefit will go up a little bit. Now, the term insurance rider is term, it's temporary. At some point that'll fall off. So it might look like, if I were to draw this out on a graph, you'd have like a ever so slightly increase. If you're putting more in, it might look like this. At some point, the death benefit's going to go down here because that term policy expired and it's no longer there. And you shouldn't need it at that point. You don't need that much coverage. You should be building assets and offsetting some of that. So I hope that answers that. Maya confirms if you borrow from your own bank and don't pay yourself back, or you take food from your own grocery store and don't pay for it, that is a loss. From the bookkeeper, you guys heard it here first. Justin says, I have a sacred account through Wealth DynamX through Guardian Life Insurance. I've borrowed from my account 4 to 5 times so far. It's been incredibly easy to do and pay back. Guys, that's what I'm talking about. Like Justin, and he's only had it for like 2 or 3 years. He's taken several loans. And the reason why is because we actually practice what we preach. Guys, I can't tell you how many loans. I just took another one last week. Like this is what I do with my own finances. So this is not some concept. And so when our clients work with us, we can actually tell them what they need to do because we've done it. This is not like, oh, I've seen this on TV once, or I read an illustration. No, we've actually done this before. It's kind of like going to a doctor for a heart surgery and getting the guy that's only ever read about it. Right. And you're like, I don't want you touching my heart. Like I want the guy that's done, several surgeries successfully. So same thing there. Let's see if we have any other questions here on Facebook. I don't see any more on Facebook. So let's jump back to Zoom. And again, if you're on Zoom, we'll be able to go live. So be prepared. I will mic you up and we will chat. Okay, a couple of questions. First one is from Michael. Let me see if we can bring Michael on live here tonight. All right, we should be almost live with Michael. All right, we're live with Michael. How are you tonight, Michael?
Good, sir. How are you?
I'm good. It's good to talk to you. What's your question?
Yes. First question was related to the banks that were covering their employees. And if the employee leaves the company versus passes away, does the company just surrender the policy, or what happens to the policy after that?
They'll usually keep it because it's permanent insurance. It will pay out no matter what, even if the employee doesn't work there anymore. So they'll usually just keep it and it'll pay out either way.
Okay, awesome. And then my second question was in relation to after taking the loan, is it possible to just repay it as a lump sum, or do you have to do the incremental monthly payment and stuff for the repayment process?
Good question. So Michael's saying when you take a loan out, can you just pay it all off at once? Like if you've got the cash laying around, can you do that? You certainly can. So that's the great thing, because it's a line of credit, you get to choose how you're going to repay that. Personally, I like making the thing that I borrowed it for repay the loan. So I really like separate out, okay, right now when I'm issuing the loan, I'm the bank. Over here, when I'm using the borrowed money, I'm the consumer. I like having an amortized payment schedule just like a bank would. But definitely, if you've got the cash, you can throw down and just repay that loan right away. And there's no penalties for that. There's no reason you can't. Good questions. Let me see what else we have here on Zoom. All right, Avery had a question early on, and I think I answered it, but I want to bring Avery online, partially because I just like chatting with Avery, but also I want to see if I did answer his question. So we should have Avery. Avery, can you hear me?
Loud and clear. Jerry, how you doing?
I'm good. How are you tonight?
Well, thanks for asking.
Cool. You asked why the spike. Did that make sense now?
Yeah, completely makes sense. I mean, it's just a matter of it being marketed a lot more and people being interested in the product and, of course, wanting to get more involved in it. But I can definitely see how the lack of education would cause someone to have buyer's remorse down the road compared to the education that Wealth Dynamics gives us.
Absolutely. Absolutely. And then you had a question on the cash value line of credit. Did I answer that already too?
Yeah, that one's clear as well.
Okay, awesome. Any other questions tonight?
All good. Much appreciated.
Hey, my pleasure. I'll talk to you later. Okay, we have a question from Nano on the term insurance. Nano, go ahead and mic up and I'll answer your question here. If we have Nano with us still.
Hey, Jerry.
Hey, Nano, how are you?
Doing great, man. You?
I'm good. I'm good. You had a question on the term insurance, right?
Yeah, that's correct. You were explaining basically how the broken down of the dollar or the $100, whatever the amount is inside the account. And I just wanted to confirm, like, how many years is the term insurance inside the policy?
Good question. So the term insurance, it usually will fall off around 7, maybe 10 years. Some people leave it on longer and it gradually drops over time in some cases. You really have to understand the purpose of the term insurance. So the contribution limit, like the limit on how much that we can put into a policy, is based on something called a MEC line. MEC means modified endowment contract. That's a bunch of nonsense in the insurance world. That basically just means there's a certain level. If you put in more money than a certain number, there's no longer a tax-free borrowing. You're going to pay taxes on your dividends and your growth. So as long as you stay below this MEC line, you can put money in and you can use it tax-free. Now, the MEC line is directly correlated with the death benefit. So the less death benefit I have, smaller the MEC line is, the less money I can contribute. The higher the death benefit, the higher the MEC line, the more I can contribute. So we don't want to own a bunch of whole life insurance death benefit. That's expensive. We don't want it all going to premium. We want to go into cash value. So what we do is we use a term rider to artificially inflate the death benefit and show the IRS a really big number. And we're like, hey, this guy has 3 million in coverage. What they don't know is only 300,000 of that is whole life insurance. And we've got $2.7 million in term, right? That they don't care. The rule is it's the death benefit tied to the MEC limit. So we inflate the death benefit after about 7 years. That's where Nano gets this from. After about 7 years, that MEC testing time is done and we don't need that term insurance anymore. So you can leave it on. Again, we can illustrate anything. So if you're like, hey, I want it to stay on for 30 years or 20 years or whatever, we can do that. But normally when we blend a policy around that 7 to 10 year marker, when we don't need it anymore, either the term falls off completely or it goes down gradually. So that's how that works. And that's a good question, Nano. All right, let's see what other question we have here. We have one from Mark. Let me bring Mark on here. All right, we should be live with Mark in just a second. How are you tonight, Mark?
Hey, I'm good. Great. How are you doing?
I'm good. Thanks for asking. What is your question?
Yeah, I already taken a loan personally from my Sacred account and in the process of paying it back, almost done paying it back. The next step I want to do is take out a loan and actually loan that money to my business. If and when I do that, does the business have to issue me a 1099 to me personally because I'm charging them interest on a promissory note? How does that work?
That's a good question. I would check with your bookkeeper. I can hear my bookkeeper, Maya, in my head right now telling me you probably would because you're paying interest. So you'd probably have to issue 1099 int. But double check with your bookkeeper and your CPA just so they can confirm whether or not that form needs to be paid. With other corporations, usually you do, but because it's yourself and technically that LLC, if it's a sole proprietor, not actually like an S corp, that's where I'm fuzzy on. Okay, well, is the IRS going to look at that as just Mark, or are they going to look at it as a separate entity altogether from a taxation standpoint? So check with your bookkeeper just to make sure. I'm sure nothing bad would happen if you did issue yourself one, but I would double check with them just to confirm that.
Okay, thank you. Thanks for that.
Yep, absolutely. All right, let me see if we have anything else here on Zoom. All right. We have a question from D. Let me see if we can bring D on live here. All right, let's see if we can unmute D and answer her question, his question. How are you tonight, D?
Oh, good.
Awesome, awesome. What is your question?
Well, I was asking if you can be too old to get a life insurance policy. I'm 66, but I was wondering if I can get a life insurance policy, like have it on my husband instead, who's 77. And that way, if he goes, then I would still have the benefit or whatever.
Yeah, that's a good question. So you can get a policy at 60s, 70s, and that age group. It will be a higher cost of insurance. So your performance might not be as good and you might not be able to get as good as a death benefit. But if you're both in good health, I think we've placed a policy on a client. I think he was 73 or 74. And so we were able to place it. We still were able to put, a couple $100,000 of coverage. Granted, he didn't have the greatest performance in the world, but kind of like Dee mentioned, is they wanted the death benefit there as well. So it can be possible if you're healthy, if there's not a bunch of complications, that's a good way to go. Now, if you're not really, if you don't care about it, getting the death benefit, and it's more like, hey, I want to do the banking concept and I just want the best performance on cash value, you can insure someone else in your family. So if you have a kid or a grandkid or whoever, you could make them the insured. They might get a better rate. And so because of that, they're going to have a better performance on that type of policy. But you certainly could put one on yourself or on your husband too. Good questions. I do want to confirm, Maya says, for Mark, definitely check with your CPA. Each situation could be slightly different on interest if it's only internal to yourself. Good point. And you could also probably reach out to Maya if you want to, Mark, and she could maybe help connect you with someone for that too. Guys, that's all I see for questions tonight. Let me just double check one more time. Yep, that's it. Good. So we're going to wrap up for tonight. I hope everyone enjoyed this. We will be talking more about these types of concepts. And again, the main thing here is, guys, don't just buy marketing phrases. Like, don't get involved in hype. This is like buying IBC on what some guy in a quick little video told you. It's no different than jumping on Bitcoin because it sounds sexy. Right? Even though they're totally different things, it's the same concept. Like, that sounds like a cool shortcut. I'm going to do that. That's a sick idea. Let me try it. Right? There's a lot more that goes into it. So do your research, do your education. If you're watching this and you'd like to learn more, grab a copy of my book, Blueprints of Financial Freedom. If you go to jerryfetta.com/B2F, again, the letter B, the number 2, the letter F, jerryfetta.com/B2F. I've got an entire chapter just on this concept. And then our team can help you put it all together on the back end. So thank you for watching. We will be back again next week, and I will talk to you all soon. Have a great weekend. Oh, I think we might have one more question really quick. Let me check really quick. Oh, just a comment. Great live. Okay, awesome. Thank you, Crystal. Okay, cool, guys. We're going to tune out here. Have a good weekend.